Hello, my name is Jason Harubin, and I am a Senior Advisor for FNBO Wealth Management in Boulder, Colorado. I wanted to take a moment to briefly address some of the implications of the Federal Reserve's decision to cut the Fed funds target interest rate to essentially zero. While this happened over a month ago, I've received a handful of questions surrounding fixed income markets and concern on why anybody should even hold fixed income securities if interest rates are near zero. The bottom line here is that there's still long-term value in holding fixed income securities as part of a diversified portfolio. One question I want to address is, are interest rates really close to zero? Well, for short-dated U.S. government securities, they are. For example, if you would have purchased a 3-month Treasury bill backed by the full faith and credit of the U.S. government, at the beginning of January this year, it would have had a yield around 1.5%. Today, the yield on a 3-month Treasury bill is 0.1%. This coincides almost one-to-one to the 150 basis points in Fed cuts that occurred in March. Similarly, you may have noticed that money market yields have dropped as well, albeit not as drastically. However, on the opposite end of the spectrum, high-yield bonds, which are bonds issued by lower-rated corporations or governments, also referred to as junk bonds, they are yielding drastically more than they did at the beginning of the year. Where on a long-term average, a high-yield corporate bond may yield 500 basis points or 5% over a comparable government bond, currently high-yield bonds yield 900 basis points or 9% over comparable government bonds. Even when you consider the bonds of higher-rated investment-grade corporate issuers, you can still find that yields are 1 to 2% higher than comparable government securities. The underperformance of these corporate bonds in the past couple of months creates an opportunity to move out of government fixed income into corporate fixed income. Your next question may be, what does this do to my portfolio? And this is where I want to stress the importance of diversification. Fixed income securities will reduce the overall risk in the portfolio because of the lower correlation to the risk of the equity markets, while providing income for your portfolio. Meaning, in turbulent markets, such as we've seen over the past couple of months, you're likely to minimize unrealized losses in your portfolio when it is properly diversified. For example, while the Russell 3000 index is down 13.6% year-to-date, U.S. fixed income is up 5%, and even high-yield bonds are only down 12.4%. In fact, looking at 10-year annualized returns going back to 1950, a portfolio comprised of 60% stocks and 40% bonds had a positive return 100% of the time. If you are interested in more information about fixed income securities and how they can help you to meet your long-term financial goals, please contact your FNBO Wealth Management Advisor. Thank you for watching and have a great day.